Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in accounting. Our topic today is stock option plans. Guys, before everything, please subscribe our channel. It is very important to us. And like our Facebook page, Accounting Hub by Dr. Scarpin. And like this video if you want to. So, what is stock option plans? Stock option plans gives employees the option to purchase specific number of shares at a specific exercise price during a specified period of time. Historical options were measured at their intrinsic values. Intrinsic value, market price of the shares, less option price at which they can be acquired. An option that permits an employee to buy a share of stocks with a market price of 25 for 10 has an intrinsic value of 15. That is the difference between market price and how much they will pay. So this is the bonus. And this option, we usually have fair value of these options. So we now measure them at fair value instead of intrinsic value. And we have a lot of models to do that. An option pricing model takes into account several variables such as exercise price, expected term of the option, and so on. For instance, Black-Scholes is the uh, one of the most used model to find the fair value of options. And how does it work? So let's go to our Excel. And I have no idea why I am not showing my camera anymore, but okay. February 1st, 2021, Skyping Corporation grants 10 million options to key executives. So 10 million options. Options permit to acquire 10 millions of companies, one per common share, within the next 8 years. So 8 years here. Or let's change it to 4 years. We don't have 8 rows here. 4 years, but not before 20. Oh, sorry. It is 8 years. Sorry. And but not before December 31st, 2024, the vesting date. The vesting period is 4 years. Exercise price is the market price, $40, estimated fair value 12. And we expect a forfeiture rate of 5%. So, how much is the compensation expense? Compensation expense, it is the option granted times the fair value. We expected 5% of forfeiture. So our total compensation, $114 million. Vesting period, 4 years. So this compensation expense will be during 4 years. How much the compensation per year? 114 divided by 4, 28.5. Journal entries. January 1st, no journal entry. We have nothing. We are only announcing it. December 31st, 2021 and 2022, the first 2 years. Compensation expense paid in capital stock option. So it is an expense and the credit is not asset or liability. The credit is equity, stockholders' equity or shareholders' equity, 28.5. During the third year, the company revises its estimate of forfeiture from 5 to 10. So, what do we have now? The previous balance for this one is 57, 28.5 for both years. The final balance will be 81. How do we find the 81 here? 81 will be 120 times 90%, that is one less the forfeiture, times 3 divided by 4. So times 3 at the end of the third year divided by 4, the vesting period for years. So the final balance for the compensation expense or paid in capital stock option must be 84. So our compensation expense will be the difference. So will be the 24. Compensation expense and paid in capital. So here, we go on here, 81, the ending balance for our paid in capital stock options. Last year, previous balance, 81. Final balance, 108. How do we find it? 120 times 1 less 10%. That is our forfeiture rate. So 10%. So it will be 108. Compensation expense, it is the difference. So it is here the 27. So at the end of the fourth year, our compensation expense and paid in capital stock option, 108, the same 108 here. Okay, now, starting on January 1st, 2025 until December 31st, 2028, if my math is not wrong, the executives they can exercise these options. So here, half of the shares are exercised on July 11th, 2027, when the market price is 50 per share. So what do we do here? We have 10 million options. Half of them were exercised, divided by 2, so 5. How much is the market value at the date uh, of the option? So it is $200 million. So this is how much they pay. So instead of paying 50, they are paying only 40. And what do we have? Common stock, $5 million. 5 million shares times $1 common share. We will exclude here on this paid in capital. So how much will be? Will be the sum of these credits divided by 2, because it is 50%. So it is 54. And then the difference, paid in capital excess of par, is the number to balance. The number to balance here, sum of debits less our credit, 249. And the remaining 5 million are expired without being exercised. So how do we do this one? We debit the number to balance. So we debit the remaining 54, but let's do the math better. The sum of debits here less our credit, and the credit paid in capital expiration of stock option. So the remaining 54, they are expired. If they are not, just copy and paste of this journal entry here. Okay, guys, that's it. Thank you so much. Questions or comments, please leave it here or email me at jscarping@gmail.com. God bless you and have a very nice day.